Wall Street is throwing another party. The music is on full blast. The S&P 500 is hitting a new record high. NASDAQ is hitting new highs too, leaving the bears of yesterday in the dust. The anthem of this rally is a two-letter word: AI. Every earnings call, every analyst note, every cable news segment is saturated with talk of artificial intelligence and its power to mint new fortunes. This isn't just idle chatter. It's the narrative driving billions into a handful of stocks, pushing the entire market into uncharted territory. For anyone with a 401k or a brokerage account, understanding this frenzy isn't optional. It's essential to know whether you're riding a rocket ship to new heights or standing on a trapdoor. So, let's cut through the noise. Why is the market so giddy? Let's start with the most tangible part of this story: the money. The current market rally isn't just based on a dream. It's fueled by the colossal profits of a select group of technology behemoths. Nvidia, Microsoft, Google, Amazon. They aren't just talking about AI, they're selling it, and the numbers are staggering. Their quarterly earnings have become must-watch events for the entire market. Eye-watering cloud revenue growth, powered by insatiable demand for AI processing. Every enterprise, from local banks to global pharma, is rushing to integrate AI and paying handsomely for it. Nvidia has become the arms dealer of the AI wars, commanding rare pricing power. Microsoft wove AI into its software and Azure, spinning up new revenue streams seemingly overnight. These aren't future promises, they're happening now. The profits are real, the growth explosive, and big enough to lift major indices like the S&P 500 and NASDAQ 100. Strong profits drive higher prices, create a wealth effect, fuel more risk-taking, and the narrative becomes self-fulfilling. AI is creating wealth, with proof in the quarterly reports. While big tech's profits provide the fuel, the market's engine is being lubricated by the hope of cheaper money. After aggressive rate hikes to fight inflation, poison for stocks, the mood is shifting as inflation cools and jobs normalize. Many believe the hiking cycle is over and the next move will be a cut. Every speech is parsed for a dovish tilt. Markets hang on whispers of cuts expected next year. Stocks equal the present value of future earnings. Lower expected rates mean lower discount rates and higher present values, especially for long-duration AI growth. Hope for cheaper money unleashes front-running. Investors buy before cuts, creating a powerful updraft. But this is expectation, not certainty. The market prices a best-case scenario. If reality diverges, the reversal could be swift and painful. Beneath AI profits and central bank pivots lies a quiet support: falling commodity prices, crude oil, natural gas, copper, lumber, the basic building blocks of the economy, have eased from post-pandemic peaks. When commodities fall, transportation, inputs, and utilities become cheaper, protecting margins and shareholders. Declines are a tailwind for profitability, helping companies meet or beat targets and win analyst upgrades. Cheaper fuel trims delivery costs, lower metals wash energy cut. COGS, airlines benefit from jet fuel, chemicals from gas, construction from materials. Cost relief helps tame CPI, giving central banks breathing room to pause and consider cuts. With lower input costs, savings can fund AI investments. Quiet contributor, big impact. It's a crucial piece of the puzzle. Artificial intelligence isn't just another driver. It's the nexus amplifying everything else. Think of it as the gravitational core around which strong tech earnings, rate cut hopes, and lower commodity costs revolve. AI provides the why for the market's relentless climb, turning data points into a powerful thesis. Big tech's earnings surge because they sell AI-infused services. Cloud AI demand is the primary growth driver. If AI boosts productivity, growth can accelerate without stoking inflation, giving the Fed cover to keep rates lower. Lower input costs free capital for AI upgrades and model training. Cost savings in the old economy funding the new AI economy. Every bull market has skeptics, and their favorite word now is valuation. Investors are paying very high prices today for profits far in the future, leaving no margin for error. Prices assume seamless AI adoption, wide margins, limited competition, and breakneck growth. One miss or slight guide down can trigger brutal sell-offs. In the late 90s, a real dream met unreal prices. Many names crashed when profits didn't materialize. Today, investors must ask if AI hype is creating a similar disconnect. Remember, early revolutions can mislead traditional metrics. Bulls say high PEs match once-in-a-generation growth. Bears say hope isn't a strategy. Truth likely lies in between. Beyond valuations, a wall of worry threatens the rally. If inflation proves stickier via wages or new shocks, central banks may keep rates higher for longer or hike again. That would pull the rug from under growth stock valuations. Announcing AI is easy. Building, deploying, and monetizing it is hard. Some projects will fail or take far longer. As excitement fades, markets demand results. Not all will deliver. New rules on privacy, bias, and security, and antitrust scrutiny could raise costs and curb profits. A surprise crackdown could send shockwaves through the sector. AI depends on complex global supply lines that geopolitics can disrupt. Escalating trade barriers or conflict could erupt with little warning, an ever-present threat to market stability. First rule: don't get swept away by headlines. Look past the narrative to fundamentals. Is profit growth sustainable? Are they generating cash or burning it on speculation? Focus on the numbers. Gains are concentrated in a handful of mega-cap tech stocks. Don't put all your eggs, even AI eggs, in one basket. Diversify across sectors and asset classes to cushion volatility. Short-term swings are sentiment-driven. If you believe in AI over 10 to 20 years, buy and hold with patience and discipline. Set risk limits, goals, allocations, and profit targets in advance. Act, don't react. A plan based on your finances and tolerance defends against emotional decisions. It lets you act rather than react. From the heights of late 2025, the view is both exhilarating and unsettling. The AI-fueled rally is anchored in real, explosive profits from dominant techs monetizing a generational shift, plus hopes for friendlier policy and lower costs. But the air is thin. Valuations leave no room for disappointment. Stubborn inflation could dash rate-cut hopes. Execution will test AI dreams. Regulation and geopolitics can change the rules at any moment. AI's arc will mix breakthroughs with setbacks, immense potential, legitimate long-term optimism. Maintain balance, acknowledge promise, respect risk, stay informed, diversified, and disciplined. Winners look past noise, separate substance from hype, and balance future hopes with present caution. The party on Wall Street is in full swing, but it's always wise to know where the exits.